Thank you, Mr. Chairman. I am proud to support H.R. 1900, the Bank Failure Prevention Act, and I want to thank my good friend, Mr. Fitzgerald from Wisconsin, for his partnership on this important legislation. This amendment, in the nature of a substitute, establishes a shot clock for federal regulators to act on bank merger applications, bringing much-needed efficiency, transparency, and accountability to a process that has become opaque and unreasonably slow. Timely merger decisions are essential to the health of our banking system. Mergers and acquisitions help community and regional banks grow into new markets, expand their services, and achieve the economies of scale necessary to compete in a modern financial marketplace, and provide lower cost and more innovative financial services and products. Regulatory indecision on merger applications impedes these beneficial outcomes. When responsibly executed, mergers don't stifle competition, they actually strengthen it. They help create more resilient institutions that can offer better services to more Americans, including small businesses and underserved communities. By enabling banks to achieve the scale and flexibility needed to invest in technology and infrastructure, these mergers ultimately benefit the customer. Unfortunately, the current review framework is broken. Regulatory delays drag on for far too long, causing unnecessary costs, uncertainty, and in many cases deterring transactions that would benefit consumers. And as we all know, failure to act swiftly can result in missed opportunities for both financial institutions and their customers. H.R. 1900 doesn't change the standards for approving mergers. It simply ensures regulators make a timely decision, giving applicants clarity and reducing wasteful delays. It's a common sense fix, and it's long overdue. What's more, this bill ensures that any delays are limited to only those cases that involve complex applications and that they are managed in a fair and transparent manner. This bill complements another bill of mine, the Promoting New Bank Formation Act, which I was proud to sponsor and this committee passed last month. I'd like to thank Mr. Lynch for his support of that bill and recognize his commitment to revitalizing community banking. The ability of smaller independent banks to form and grow is essential to a competitive and diverse financial sector. Together, these measures aim to restore balance and competitiveness and dynamism to our banking system, ensuring community institutions can thrive, innovate, and better serve the people who depend on them. It's important that we acknowledge the reality that our banking system is evolving and that we must continue to make legislative adjustments that promote both stability and dynamism, and recognize that the competitive landscape and the ecosystem for banking is different. It's not just that banks are competing with other banks, it's that banks are competing with a lot of non-bank financial technology and other firms and payment systems. In recent years, we've seen a steep decline in merger activity, largely due to the posture of the previous administration, which effectively shut down the process. That was not a policy of prudence, it was a policy of paralysis. By fostering an environment of regulatory uncertainty and unnecessary delays, the last administration inadvertently hampered the ability of financial institutions to adapt, innovate, and grow in an increasingly competitive global marketplace. While I'm encouraged that the FDIC and OCC rescinded restrictive merger policy statements and rules, that alone isn't enough. Congress must act to restore a fair, functional process consistent with the intent of the Bank Merger Act, which was to preserve competition, not block all consolidation. We must ensure that regulations are not used as a tool to stifle growth, but as a safeguard to ensure that any merger is in the public's best interest. This legislation does just that. It strikes the right balance between accountability and efficiency, ensuring that the review process remains robust and also responsive. By establishing clear timelines for regulatory decisions, it ensures a predictable, reliable process that banks, investors, and consumers can rely on. In addition, the bill emphasizes that decisions should be based on clear, documented criteria, preventing third parties from unduly influencing the process. This is crucial for ensuring that banks are judged fairly and that the process is not swayed by outside pressures that may not align with the interest of consumers. Finally, the bill is called the Bank Failure Prevention Act for a reason. Healthy mergers protect the deposit insurance fund and allow strong banks to acquire weak banks that are at risk of failing. This bill prevents that and makes sure that healthy mergers protect the deposit insurance fund. I urge my colleagues to support this bill and stand with us in promoting a banking system that is both competitive and innovative, with a regulatory framework that is efficient, fair, and transparent. Together we can make sure that our financial institutions have the ability to grow, compete, and serve all Americans more effectively. Thank you, Mr. Chairman. I yield back. The gentleman yields back. Who seeks recognition? The ranking member of the full committee, Mrs. Waters, is recognized.